So this is the chapter on long-term liabilities, and we look at a couple of different kinds. We look at bonds payable and we look at long-term notes payable. A couple of things we don't look at that you'll be happy we don't look at are pensions and leases. Those are other possible long-term liabilities. So let's start with bonds payable, and this video will be mostly on a lot of terminology that may seem sort of, I don't know, annoying or whatever, but it will come in handy in doing the journal entries just because it gives you a little bit more understanding of all the terms involved here. Most of us have, or at least some of us have had notes payable, car loans, mortgages, things like that. We get that concept. But most of us have never issued bonds or really know too much about them. So we'll kind of start why would a company issue bonds? Well, it's not just, first of all, it's not just companies that issue bonds. Corporations can issue bonds. It has to be a corporation that issues it. Also, government agencies can issue bonds. The MBTA in Boston could issue bonds to maybe upgrade the service on the Green Line or something, maybe buy some new cars. The Commonwealth of Massachusetts has issued what they call green bonds to build the infrastructure for the wind farms out of New Bedford. So it can be cities that issue bonds, corporations, and various government agencies and the government itself. So there's different sorts of bonds. Any agency or corporation that's issuing bonds is usually doing it for long-term projects. Maybe a corporation would be building a whole new plant facility. They want to have some long-term financing to cover that. Maybe they want to be pension obligations. There's all different reasons that they'd want to take on long-term financing. Okay, so I talked a little bit about the different types of long-term liabilities. Let's see, the difference between a notes payable and a bonds payable. Notes payable would be due usually to one lender. You have a notes payable to the First National Bank. You've got a note payable to some supplier. You've got a note payable to someone who has lent you money. Bonds payable are different. When a company issues bonds payable, you talk about the bond issue, and that would be they did a $10 million bond issue, but nobody's buying $10 million, a $10 million bond. There's going to be a whole bunch of maybe $1,000 or $10,000 bonds that are sold that make up that bond issue. So bonds are owed to a whole bunch of different creditors, to everyone who bought each of those $1,000 or $10,000 bonds that makes up the $10 million bond issue. Okay, let's see, so what else do you need to know about that? To issue bonds is a lot more complicated than issuing a notes payable. With a notes payable, you simply have your agreement that you sign. You sign the note, and it's fairly straightforward. You usually get a lawyer involved. But with bonds payable, you have what's called a bond, and it's just kind of a weird word, the bond indenture agreement. It's not like the bond has, well, it just sounds like that's got dentures or something, but it's a bond indenture agreement. And that, usually the company will go to one of the large investment bankers, JP Morgan, someone like that. They will draw up this bond indenture agreement. That tells all the terms and conditions of the bond. Then that bond indenture agreement, along with a bunch of other information, goes to the Securities and Exchange Commission, who has to approve the bond issue. The corporation cannot issue bonds without that approval. So what we have to know here is that to issue a bond takes time. And so in that bond indenture agreement, there'll be things like the interest rate, the stated interest rate on the bond. How much interest is it going to pay its bondholders every so often? And that stated interest rate may be a little bit different than the interest rate that's out there in the market when the bonds finally get issued, because it may take a matter of months to get a bond issue approved. So that is how this plays into the accounting for bonds. Okay, the book talks a little bit about debt financing versus equity financing. And I'd refer you to the notes on that because it sort of takes you through in a step-by-step process. When we're talking about equity financing, you have to think of assets equal liabilities plus stockholders' equity. Equity financing is when the company is issuing stock to finance its operations. So if you think about when a company issues stock, they get cash, and then they've issued common stock. Okay? That's equity financing. If they did cash and they issued a bonds payable, that's debt financing. It could be a notes payable or a bonds payable. But debt financing it's taking on a liability. Equity financing is issuing stock. Okay, so you just need to know the basic differences there. And let's see, what else do we need to know about? Oh, there's a lot of vocab that goes with bonds, and that may be helpful to you sometime in the future. I mean, once you get out of Mass Bay, and because you went here, you get a great job, and you have a little bit of money to invest every month, which is exactly what you should be doing. You may want to know all the terminology that goes with bonds. For now, the terms that you really need to be familiar with are simply convertible bonds. We can convert bonds to common stock. And callable bonds. It's like, hi bond, I'm calling you here. No, it's callable bonds. This is one where the company can retire the bonds before the maturity date. Knowing that terminology and what they're about will be helpful in doing some of the journal entries. Okay, bond trading. Okay, I think I mentioned a little earlier that the company will issue the bonds through an investment banker, Citicorp, Morgan Stanley, and the investment bankers will help draw up the bond indenture agreement, and that has the maturity date, all the other information about the bond, all the sort of rights and obligations associated with it, and because it takes time, the interest rate that it says on the bond, which is what the interest rate paid to the bondholders, may be different than the market interest rate, which is going to make a difference in the amount of money, the proceeds we get when we issue that bond, when the company issues that bond. So we'll see how that'll all start to make sense, or hopefully it'll start to make sense when we do the journal entries. Okay, so that's sort of your bond basics, and we'll next move on to the accounting for bonds payable.